Welcome back. This is Unit 1, Part 3 of our look at the accounting cycle. In this lesson, we're going to take a look at two things. First off is I want to introduce some really basic accounting equations, such as the balance sheet equation. And then following that, we're going to start analyzing transactions. And I'm going to use throughout my module on the accounting cycle the case study of SoftBite SA to do that. So first off, the accounting equation is actually really basic. Earlier, we talked about assets, liabilities, and equity and how they feed into what is known as the balance sheet. So what is known as the balance sheet equation simply states that assets is equal to liabilities plus equity. That's it. Before we go any further, I'd like to just explain what I will call the income statement rule. Earlier, we talked about how revenue and expenses will feed into the income statement. So now I'd like to introduce what I will call the income statement rule, and that is a company's profit is equal to revenue minus expenses. And it's really important to understand the difference between what profit is and revenue. I've met a number of accounting students who confuse the two. So let's make sure we understand what profit actually means. And keep in mind, profit can also be a loss if expenses exceed revenues. Another equation I would like to introduce is retained earnings. So retained earnings then is equal to profit minus an owner's withdrawals. Or remember, another term we can use for withdrawals is dividends. Anything taken out of the retained earnings. I'll get to that equation a little bit later on in the course. So now then, I would like to introduce what I will call the expanded accounting equation. And so that basic accounting equation, assets is equal to liabilities plus equity, it still stands, it still exists. But we can see here, I've expanded out the equity portion of the equation. Equity then consists of share capital or owner's equity, as we talked about earlier, plus the company's retained earnings. And remember, retained earnings is the company's cumulative profit less any dividends or withdrawals. And so we can see here then, retained earnings is equal to revenues minus expenses minus any dividends or withdrawals from the company. I want to focus now on equity to make sure that we understand how different transactions affect the equity account. So, number one, increases in equity can result in investments by shareholders, that being a contribution to owner's equity, and any revenues that the company earns. Equity will increase in those cases. Equity will decrease as a company incurs expenses, as well as paying any dividends to shareholders. So this relationship here is really important for our understanding of the accounting equation. Now let's take a look at transaction analysis. As I said earlier, we're going to take a look at 10 different transactions for SoftBite SA. And the first thing I want to make sure we understand is what is a business transaction. So these are economic events that are recorded in the business's accounting information system. Each transaction must have a dual effect, and this is known as double entry accounting. And so every transaction then will have two effects on the accounting equation. And so before we move on, we need to think about how a single transaction will have these dual effects on the accounting equation. So as we start to analyze these different transactions, I'd like you to remember these following points here. We're only going to record financial transactions. So any transaction that does not have some sort of economic impact on the firm, we're not going to record. We can only use accounts that are in our chart of accounts. We cannot make up any new categories unless we add it to our chart of accounts. Each transaction that we look at it's going to have a dual effect on the accounting equation. And then finally, for all transactions, the balance sheet rule must apply. So for our purposes, this is a bit of a simplified chart of accounts. I've took this from our textbook here. And so these are the categories that I would like to use for this initial stage here. And so in terms of assets, we can only use cash, accounts receivable, supplies, and equipment. I've expanded the equity portion, specifically the revenue and expense accounts. So for revenue, we'll have service revenue and other revenue. And for expenses, we're going to use rent expense, salaries expense, and utilities expense. So I've just kind of expanded our chart of accounts a little bit for this particular stage here. This is actually step one in the accounting cycle here. So it's important that we pay attention to how these transactions affect the balance sheet equation. Before we go any further, you can also refer to the case study example on SoftBite SA for a list of the 10 transactions that we're going to analyze. But let's take a look at the first one. So the first one is an investment by shareholders. Ray and Barbara, they're going to start a smartphone app development company called SoftBite SA. And on September 1st, they invest $15,000 in cash in exchange for $15,000 of ordinary shares. So the obvious part is that the business has experienced an increase of $15,000 in cash. And so now let's take a look at the full double accounting impact on the accounting equation. We can see here that cash, an asset, has gone up by 15,000, and also share capital has gone up by 15,000. So if we take a look at this transaction here, the accounting equation still balances, which is the key. Assets is equal to liabilities plus equity. The second transaction, the purchase of equipment, and they're going to pay cash for it. SoftBite SA purchases computer equipment for $7,000 in cash. So once again, the easier part of this equation says that we spent $7,000, but in exchange for that $7,000, we got $7,000 worth of computer equipment in return. So how does that impact the accounting equation? Our cash balance, it went down by $7,000, but our equipment balance has gone up by $7,000. And once again, the accounting equation balances. Let's take a look at the third transaction here. In this case here, we're going to purchase supplies on credit. SoftBite, we purchase headsets which are expected to last several months. So because they're only going to last several months, this is not a long-term asset. This is still a current asset. We've paid $1,600 from Mobile Solutions, and Mobile Solutions has agreed to allow SoftBite to pay the bill in October. So they will receive the headsets in September, but they won't pay the bill in October, until October. So this results in what is known as an account payable. We've received the asset today. We will include it in supplies, but we will not pay until October. And that results in that account payable to Mobile Solutions. The fourth transaction, we've performed services for cash. So we received $1,200 from customers for app development services, and this work is the principal revenue producing activity for SoftBite SA. And that's very important for us to understand. Once again, in terms of how this affects the accounting equation, we've received the $1,200, so our cash balance is going to go up, and our service revenue, we've now incurred $1,200 in service revenue. By default, that increases our equity. And so therefore, our accounting equation still balances. The fifth transaction, in this case, we're going to purchase advertising on credit. Once again, when we say on credit, that means that we receive the benefit today, but we're not going to pay until a later date. SoftBite, we've already done some advertising on Programming News on its website, but we've just received the bill today, and we're going to postpone payment until a later date. And so for this example here, we're going to incur an advertising expense. It's an expense, and we're going to incur an advertising expense. We haven't paid for it. We haven't used any cash for this, but we have incurred an account payable. So the account payable balance is going to go up. So when we apply the accounting equation, an expense reduces equity, and the account payable will reduce liabilities. Once again, our accounting equation will balance. We are halfway there. So in the sixth transaction, we've performed services worth $3,500, but we've only received $1,500 in cash from our customers, and the balance is still outstanding. We're going to recognize then what is known as an account receivable in this example. So our cash balance has gone up by $1,500. Accounts receivable has gone up by $2,000, and we're going to recognize the full amount of the revenue of $3,500. It's important for you to notice here that we're entering $3,500 in revenue, but we've only received $1,500 in cash. And so selling on account, you should understand, it uses up our cash. And therefore, a lot of companies, they need to be very careful with regards to accounts receivable and granting that privilege to your customers. The seventh transaction. In this example, we're going to pay off a series of expenses. SoftBite SA, we've got the following expenses for September. Office rent of $600, salaries of $900, and utilities of $200. These are all expenses. And so let's take a look here. We've paid cash for all of these expenses. And so therefore our cash balance has gone down by $1,700. And we're going to enter or acknowledge expenses for rent, salaries and wages, and also utilities. They're all expenses and they all reduce our retained earnings, but we're going to separate them out for now. And you can see here that it reduces our assets. It also reduces our equity, and our accounting equation still balances. Transaction number 8. We're going to make payment on an account payable here. So remember back in transaction 5, we received the benefit of the advertising with Programming News. We did not pay right away, but finally we're going to pay now. So we're going to pay our $250 bill in cash. What's going to happen here then is our cash balance is going to go down, and our account payable to Programming News is also going to go down. And so that with double entry accounting, we can see here, always the accounting equation always applies. Transaction number 9, we're getting there. The receipt of cash on account. And so remember that we had some outstanding account receivable balances. Finally, we're going to get paid. And remember, with accrual accounting, we recognize revenue when we've earned it, not when we receive the cash. And so this particular transaction does not affect our revenue account. It does affect our cash account because we received $600, and we're going to reduce our accounts receivable balance because now we've collected on it. And you can see here the effect on our assets. There's actually no change in our assets because of this transaction. and the accounting equation balances. And finally, transaction number 10, the payment of dividends. At the end of the month, SoftBite SA decides they're going to pay a dividend of $1,300 in cash to both Ray and Barbara, who are the shareholders of the company. And the effect of this transaction then is kind of interesting. It's important to remember dividends are not an expense, so we cannot include it in expenses. And you can see here that dividends paid or withdrawals are shown separately. It is not an expense, and that's really important. So we can see our cash balance has gone down, and our dividend account also has gone down as well. And so we can analyze that transaction. The accounting equation still balances, and therefore our entry is valid. So this following here is just a really quick summary of all of the transactions that we looked at here. And remember, for each transaction that we analyzed, there were two impacts on the accounting equation, and at all times, the accounting equation balanced. And so just as a check and balance, that's what you should be looking for when you start to analyze transactions. So before we move on, just a couple of points that you should pay attention to here. Analyze each transaction in terms of the three components of the accounting equation: assets, liabilities, and equity, and the specific type of items in each account. The two sides of the accounting equation must always balance. Assets is equal to liabilities plus equity. That must always apply. And also to the equity section indicates the causes of each change. This brings us to the end of Unit 1. We have an understanding of the basic foundation of any accounting system, the chart of accounts. We've also been able to analyze different types of transactions and to understand how they affect the accounting equation. Next, we're going to take a look at the accounting cycle in earnest. And we've actually done step number 1 already by analyzing transactions, but now we're going to apply that into an accounting context. We'll see you then.